All right, on today's episode of Building Wealthy Habits, we want to break down stock options. We have many clients that work for employers of all different sizes and types, but oftentimes as a part of their compensation package, they get stock options, and there's all different types, and it can become really complicated really quickly. So what we want to do is kind of simplify things, but talk through what are stock options, what are the general types of stock options, and some things to keep in mind in regards to stock options. So Jeremiah, go ahead and kick us off. Can you just talk in general about kind of just the reason why some employers choose this option as a part of the compensation package?
Yeah, that's great. And the types of stock options we're talking about today are not like I'm going to buy an option in the market for like a protective put or some sort of like complex investing tool. These are stock options that your employer gives you. You work for a tech company, you work for a startup, you work for all sorts of different types of companies, and they give you stock options as part of your compensation. And the reason people do this, the most common reason, is as they're a growing company, they're able to keep some of their cash. They don't have to pay people as much cash right out of their pocket. So it keeps their cash flow healthy. And they're able to give these incentives of these stock options that allow their employees to participate in the growth and the development of the stock price of the company. Now, for most people, you're only going to get stock options if the company that you are working for is public, meaning it's a public company, or it's planning to go public in the future. There's some other times where early stage startup people will pay people in stock, but it's most common. What we see is people who work for Amazon, Salesforce, Instacart, some of these big tech
Mhm.
companies that as part of the compensation package, the employer will give them stock options.
And I'm going to add on, it's typically a firm that's in kind of a growth stage of its business because otherwise it wouldn't really be a compelling piece of compensation. So you're typically talking about a publicly traded company or one who's just pre-IPO and a firm that's kind of growth oriented or anticipating strong growth.
And so the benefit here is that you get to, as an employee, receive these benefits. And there's what we're going to get into is they come in all different shapes and sizes, and they come in different tax categories of what that's going to mean for you. But what you get to do is you get to receive and enjoy these. And often there's what's called a vesting schedule. We'll get into this in a little bit. But the idea being when they give it to you, it's not that you just get to immediately go to the market and sell it and get the income. You have some sort of loyalty to the company. So that's the other piece of why companies use these is they're able to provide higher compensation to their employees. But also in doing that, they're kind of tying those key people back to the company for a number of
Right.
years.
So they're incentivizing retention, which from the employer's perspective is obviously something that's valuable to them. But it's not necessarily a golden handcuff, although some stock options can be framed as such. But for several years, typical vesting schedules are anywhere from 3 to 5 years. Some are a little bit different, but that's kind of what's typical of what we see.
Yep. Yeah. If you work in the tech industry, you're going to hear 4 years with a cliff. That's a very common structure in the tech industry, that there would be a 4-year vesting, meaning you have to stay with the company for 4 years. But once you get there, there's a cliff, meaning everything vests and you now become fully able to exercise the options. But like you said, every employer is different.
Yeah, and when they say vesting, and we'll get into some more details later, it's not necessarily that it's just 0% until the fourth year and you get 100% vested. Typically, it's broken down equally per year. So in that case scenario, it'd be 25% vesting schedule for the total value until the end. But they're all a little bit different. It's important to understand the vesting schedule. So it's a way to attract talent. People want to come into growth-oriented firms, especially those individuals who are also growth-oriented. They want a piece of the pie, so to speak. It's a way to retain employees over long term, and it aligns incentives, right? So if you're offering stock options to your employees, they have a literal vested, there's that word again, vested interest in the future of the company. So oftentimes companies do this as kind of a part of their vision and their way to bring the employees alongside them in executing the vision. So, okay, so we've talked about the types of companies, the reason why they might do it. Let's kind of dive into RSUs versus RSOs. Tell me what I'm
Yeah.
talking about.
What those mean, yeah. And this episode, just as a comment, it's for anybody who receives this kind of compensation and they're figuring out what to do with it. Anyone whose family or their children or their colleagues receive this kind of compensation, or anyone who's just curious. This is something that is very common in the industry out there. So jumping in, the definitions: RSUs, RSOs. So RSUs are called restricted stock units, and it has a lot to do with how these vest and how you receive them. The RSOs are restricted stock options. And the biggest difference, and there's a lot of differences we'll kind of talk about, but the biggest difference I feel is just taxes. how are these going to get dealt with in a tax way? What do you get to do with them? What do you have to be careful of? A big thing I would say, whenever we have clients that come in that have RSUs or RSOs, we talk a lot about getting a roadmap of what their taxes are going to be over the next 5 to 10 years, not just in what they're going to make, but when these options are going to trigger taxes, making sure they have the cash flow to deal with it. It can be complex. A number of folks, they really get caught in some unintended tax situations because they didn't quite understand how these were going to impact them. It's good value, but you have to kind of walk through them carefully.
Yep. I would say the other big difference between the two is RSUs is you're just given the stocks and they vest, right? Which is when they become sort of actualized in your account and you have the option to trade or retain them. Restricted stock options give you the right to purchase the stocks sometime in the future for a set price. So that's maybe a little bit of difference too to call out between the two.
Yeah, that's great. Remember back at kind of a fun story. I was in college and I had a roommate who was working in the tech industry and he was still in college, but had a good internship. And he said, "Hey, I got a full-time offer. They're going to give me stock options. Is that good?" Like, it was a great moment of, I was a business major at the time and, getting to walk through of like, oh, well, that's great. Like that's a great idea. And he's gone on to be very successful in what he's doing, but it was a great moment of him as a young college kid in an internship getting his first full-time job with a kind of a small startup tech company, excited to have the job, but part of his compensation package was stock options. And at the time, he didn't even know what they were, much less how they work.
Mhm.
But it was just a good, as Laura said, it ties everyone together to say, okay, you're part of this, you're part of the growth, but let's kind of move forward together. We can dive into the nuts and bolts a little bit. I think we're going to start with the RSUs, restricted stock units. We've seen a fair amount of those lately, and I don't know if it's simply the folks we're working with or if those are becoming more popular. But we have a number of
Right.
folks who are high up in their companies, their leadership,
Mhm.
and they're receiving restricted stock units as part of their compensation. And so they get a normal salary. They also get some bonuses at times. But a big portion of their total compensation are these, they almost come through almost as a bonus, but it's these restricted stock units. In doing this and receiving this, for these, think of them, it's part of your compensation, which then, of course, leads to ordinary income taxes, all of those questions. But that's kind of where we start with it to say, okay, what are they getting and when do they get to receive these benefits?
Right. It's a little tricky because you might, if you're one to receive RSUs, receive an account statement that looks like it has two accounts. One might reflect the value of the RSUs unvested, meaning that you don't have access to those stocks yet, but they have been sort of granted or designated to you. Then, according to the vesting schedule as it's applied, let's say, for example, it's 25% vesting. Within that calendar year, 25% of the value of the vested stock will then come over to you. It's poured into a kind of vested account. It might be held with the same custodian. So it literally just looks like two accounts side by side. Now, once the stock units have vested, there's a couple things that happen. Number one, they're treated as earned income. So let's say at the end of the prior year, you have the amount of stock units being shared with you, and maybe the stock price at that time is $30 a share. At the time that they vest the next year, the value may have fluctuated. It could go up or down, but that actual value as they sort of pour over into your vested stock or investment account is now yours to handle. It's going to be considered earned income. And so many employers withhold taxes according to what your standard withholding or however you direct them. So oftentimes they sell off extra units of the stock to cover whatever tax withholding you've asked them to do so. And then the value of those stock units land in an investment account. And after that, there's a couple decisions to be made. If, let's say, at the date of exercise or vesting, the stock value is $50 a share, you then have the option to retain the stock, but now you're highly concentrated, for example, in one holding. These are typically growth oriented companies. So the answer that I like to say is it depends, right? Some clients have a vested interest in this company and they see its potential growth over time. So oftentimes they retain a portion of that stock, but maybe start to diversify the rest. Now, if they do that at the time that the stock vests, there's zero capital gains because at the time, if it's $50 and then you go to diversify, there's going to be no change in the value of the stock. If they wait for some time after that, there's going to be a change in the price up or down. And that means there's going to be a capital gain or loss recognized when they go to sell the stock going forward. So I got a
That's
little in
great.
the weeds. How'd I
No,
do?
that's great. No, you got through it, and I think even that for anyone listening, like that is through the weeds of how this works out. But I think the big takeaway is there's going to be some taxes, but you also have some opportunities to decide. I like even your comment of do you want to build up a large position in this company? Do you believe in the future? And we see a lot of clients that they believe in the future of their company. They believe in what they're doing, and they feel comfortable holding a larger portion of their employer's shares because they've been given them. Sometimes they do it on purpose. Sometimes I think they just do it because they were given these, and so I guess they want to keep them, and they have a concentration in one position of their company stock. And I think there's part of that that's really great, right? You're putting all your eggs in one basket. You work for the company, you're investing in the company, you're moving forward. And we've talked about before that concentration helps build wealth, but diversification is what preserves it. And so when someone is getting their first stock unit, as you go on and your wealth expands, there becomes, just as you said, there's a moment of, do we need to diversify this to make sure we're not so reliant? And the reliant, we've had clients that they'll see their total wealth, their total account go up meaningfully and then come plummeting right back down and then go up again and then come right back down, because having one position, one stock held in your portfolio makes it volatile.
A little bit of a roller coaster, that's for
Yeah,
sure.
and you could live in that, right? And say, hey, we're doing
Yeah,
great. Oh, we're doing poor. We're doing great. We're doing poor.
yeah,
And the other part that I think we always talk about is, if the company starts doing poorly, your employment, your actual job could be at risk. And then also now your investments could be at risk. And so I think there is something to be said to make sure as you develop in a company to, of course, hold some of the stock. That's wonderful. Participate in that. Of course, it depends, as you said, Laura, it depends on everyone's situation, but that's a common conversation we have of making sure that people are diversifying as they grow so that their stock
yeah,
portfolio is robust.
yeah. Well, and let's say at the time when you were initially awarded the RSUs, the value of the stock, it was the opposite in my illustration. The value of the stock was $50. And then at the time of vesting that year, they're actually only at $30. So
Mm,
the value has reduced as it kind of pours over into your vested brokerage account. So we do have clients that say, I anticipate this is going to go back up to $50. Not to say that they want to place a bet, but they say, okay, for maybe exceptional circumstances, they've seen the stock kind of take a hit or adjust, but they anticipate that it's going to go back up. They're willing to pay that capital gain or that differentiation to wait for the stock to go back to a certain price. So we can also set some triggers along the way. We still think overall, to Jeremiah's point, that idea that concentration builds wealth, but diversification preserves it. The answer to sort of what's right for you is it depends. It depends on where you are in life, what you need the funds for, what you're planning to use them for, how risk averse are you and or your spouse if you're addressing this together. And so sometimes, there's some sort of compromise. It can be like a yes and. I want to stay 10 to 20% concentrated in this one company, but no, you're putting a lot of eggs in one basket. To Jeremiah's point, not only your employment, but also part of your investment, your long term investment portfolio. But RSUs are fairly straightforward for the time that we have. I think now's the time. Let's move over to RSOs. How do they compare to RSUs?
yeah. So restricted stock options usually come with a large employer plan, meaning that there's something that's documented, it's set up. There can be some really good tax benefits of being able to receive this stock at a certain level and letting it grow and then experiencing the taxes later. RSUs are kind of locked in. As soon as they vest, you experience the taxes. Whereas stock options, you could control a little more when you experience the taxation on those shares. The biggest one, and we won't get into it, but is an AB election. If you have any stock options or restricted stock options from your employer, you should look into what an AB election could mean for you. It's a tax
Hmm.
code that allows you to pay taxes early, or you can choose to pay them late. And when you pay them, it's going to make a difference on how much you pay. So we won't go into that one today, but just as a comment, if anyone has stock options, talk to your accountant, do some research, talk to an advisor, make sure you're aware of whether an 83B election could be helpful to you. So that's a caveat.
RSOs in general, just so you know, are a little bit more complex than RSUs. And so I would generally recommend someone to speak with an advisor and definitely their CPA. Types of RSOs, generally speaking, are ISOs and NSOs. And the treatment of tax and the whole strategy behind those two is different as well. So there's a lot of complexity behind RSOs.
Yeah. Well, even just open, we talk about this regularly with our clients. There are advisors across the country that this is all they really deal with, are people who receive these types of ISOs, RSUs, all sorts of different options. And all their clientele are receiving these types of compensation packages. So if you feel a little lost, or if you feel like it is something that matters to you, there's a lot of firms out there that actually specialize in this type of compensation. And so you don't need to go this alone, and you don't need to try and figure this out yourself. There's advisors out there who are well versed in all of these. In fact, they may even have a number of clients from your same company, and they know your exact stock plan and how it works. And so you can get some good advice from advisors who are well versed in this. So I think the idea that they're complex and that it matters, I think, is a good takeaway here. But why don't we transition a little bit just into the vesting? We talked a little about this. I think the vesting schedules for an employee are really, really important. One, it helps dictate when you might be paying taxes. But two, even for your career, we've had employees that say, well, I know I have to stay here for 4 years. I know I have to stay here for 5 years because there's so much value I've received from these options, and I don't get to keep them unless I'm here for a while. And it's good when you talk about life planning. Some people might want to do this forever. It's common that people change jobs, periodically.
Hmm.
But if you have stock options, it's another layer that goes onto your life planning of saying, hey, I might be locked into a job because of my vesting schedule for a number of years because it's too painful to walk away from some of that value.
Yeah, because clearly stated, if you do separation of service or you quit your job, you will lose the value of the remainder of the vesting schedule. So that's where that retention piece comes into play. So it makes it a little bit trickier to leave when
Yeah,
you're awaiting
yeah,
some vesting
yeah.
shares.
But the exciting part that we love to work in is when we have a clear vesting schedule, we understand the household, what they're about, and they now understand, how these compensation is going to actually come into their household and support their families. Man, it's a really great level of confidence. It went from extremely complex. And I guess I would say I see analysis paralysis in these, that people will receive these shares, options or units, and they have them and they don't really know what to do with them. And they know anything they do is going to have some tax results. And so because of that, they just kind of sit and hold. And we've had a lot of clients when they start working with us, they have a backlog of these options that they've just kind of sat and held. And I love it when they can walk away with that confidence to say, hey, I see how these units are going to benefit our family. We want to be smart with the taxes, but we also want to utilize some of this for our daily living and our future. So I
Hmm.
think the mentally unlocking some of these assets is really, really powerful
Hmm.
for folks. So I think that's probably the number one concern I see is people come in and they just feel that these are locked away from them. They don't really
Hmm.
understand because of the analysis paralysis.
Absolutely. The tax consideration, broadly speaking, for RSOs is different. So you're granted a set amount of options at a certain price, which, again, going back to what I said earlier, means that you then have the opportunity to buy those stocks at a future date at that set price. Now, the stock value might have gone up or down, and that depends then when you go to exercise that option, what is going to be taxed. And they call that the spread, the difference between your stock option value and when you actually go to exercise the option, what the value of the stock is at that time. And then if you go to retain it for a certain amount of time, then there might be capital gains treatment applied, which is a preferable tax rate prior to exercising or diversifying the stock. So this is where it gets real complex. And I don't, for the sake of time, want to get into too much of the details here, but the tax treatment of RSOs is slightly different from RSUs, and you definitely want somebody coming alongside you to help kind of counsel you.
Yeah. So I think for anybody out there, as we kind of come to the end of our time, like celebrating the fact that you have an employer who is generous in their compensation packages, right? I think celebrating that, but also knowing that this is not something that is locked away from you or too complex for you. And I think getting a
Mhm.
plan of how this compensation package and stock options or stock units can, support your house and your family now, as well as well into the future. So it's an exciting thing. We work with them all the time. It's a useful part of people's compensation. So if that's something that you or someone in your sphere of influence is dealing with, either get someone in your corner who can help guide you through.
Yep. The other one I would add is there are ways to turn this concentrated compensation into diversified long-term freedom for the individual if used correctly. So we hope this was helpful to our listeners. Thanks so much for tuning in. We have a few more things to let you know about before we go. Podcast reviews really help us to serve more people and get this information into the hands of the people who need it. Please leave us a review. Even if it's not 5 stars, we welcome the feedback.
And we invite you to let us know what topics you would like to hear more about or what would benefit the people in your life who you're closest to. We have more resources online. Those resources are designed to help you share this great information easily with people in your life. To access those resources, please visit tricordatvisors.com.
Often we hear from clients that they wish they had talked to us sooner. If that's you, We'd be thrilled to see how financial planning can benefit your life. Email us at contact@tricordadvisors.com or simply click on the link in the show notes.
We love creating content that's useful, resourceful, and maybe even a little entertaining. We want to make this mega universe of financial topics and advice applicable and helpful to your life.
Remember, at Tricord Advisors, we are your future's best ally.